Hey everyone, in this video I'm going to discuss one red flag for SoFi stock in 2023 and beyond. That isn't to say that I don't like SoFi stock as an investment or SoFi as a company. I'm just pointing out one red flag, right? Every company, every stock has at least one risk associated with it, and right now I think this is one red flag for SoFi stock, so I thought I'd share this with you in this short video here. So what is the red flag? It is personal loans. In its most recent quarter, SoFi originated record volumes in their personal loans business, which grew 46% year over year to nearly 3 billion. On its own, that wouldn't be a bad thing, right? Growing one of your business segments by 46%. What's troubling is that it grew while the rest of the business declined. Let's look further. Student loan originations were down 47% year over year. Now, of course, that's due to the student loan moratorium, right? But then home loans were down by 71% year over year. And in fact, I think SoFi made that acquisition as a result of how the slow progress they noticed in their home loan business, right? They're having such difficulty gaining traction in the mortgage industry that they went out and acquired a company that should help SoFi boost its home loan originations. But for now, down 71% year over year, student loans down 47%, and personal loans up 46%. What that means is now personal loans make up a far larger percentage of the company's overall business. I'll show you this one slide from its investor relations presentation site. It gives you its balance sheet information, assets, and liabilities. And if you look over here on its loans held for sale portfolio, it has $9.6 billion of personal loans held for sale. In total, it has 16 billion. So personal loans make up 9.6 billion of the total 16 billion. Now these are loans held for sale, meaning that the company is trying to sell these loans to other investors. And one of the reasons why they have so much of the personal loans held for sale is because they have difficulty selling them to other investors. It's not just that they're originating a lot more of these loans, it's that the demand from investors in the market for these loans is falling because they're higher risk loans. Personal loans are higher risk loans compared to student loans and home loans. Home loans are the least risky, right? That's the one you want the most of because those are backed by homes. If your borrower defaults, you can foreclose on the home and you have collateral to take back. That's the area you want the growth, but this is where SoFi has the absolute least in total available for sale. Look at that. So um, they elaborate here. Management says their personal loan borrowers have a weighted average income of $164,000. That's a nice annual income, and a FICO score of 747. That's also a nice FICO score. But compared to their student loan borrowers, which have a weighted average income of 173,000 and a FICO of 769, so their student loan borrowers are higher credit, higher income borrowers. That's where, as a SoFi stock investor, you want to see a little bit more. And hopefully, when the student loan moratorium ends, SoFi can return to that business. And then the home loans, that's definitely where you want more growth. And then they go on to elaborate on the default rates, right? On their balance sheet, delinquency rates and charge-off rates remain healthy and are still below pre-COVID levels. On our balance sheet, 90-day personal loan delinquency was 38 basis points, and the annual rate was 2.97 percent. But compare that to student loan delinquency, which is just 12 basis points. Look at the personal loan delinquency, 38 basis points, student loan, 12 basis points. So the rate of default is more than 3 times the level in personal loans compared to student loans. That's the data that SoFi is sharing with us in this instance here. And this is when, during a time when consumers are still in a relatively strong position in terms of their balance sheet, right? During the pandemic, there was several rounds of stimulus payments sent out to consumers, and that gave them higher bank balances, and that's allowing them to, stay afloat even if they are facing higher inflation and all of the other headwinds. They've got that bank balance that's higher than it was before the outbreak, so that's letting them go on here stronger than usual. As SoFi management notes here, it's better than pre-COVID levels. So for now, it's not a problem. It looks okay. Their default rates, but it's just a red flag to look out for in case there is a recession, or if that recession is more severe than expected. This part of SoFi's business could be impacted significantly. That's why I highlighted it in this video as a red flag. All right, so it's just one red flag for SoFi stock investors to look out for in 2023 and maybe even beyond. All right, that's all I've got for this video. Thank you so much for watching. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.